Welcome to the Ellsworth Advisors monthly update for November 2023. I'm Kelly Keenan. This is Cameron Mealy, and today we will discuss how our portfolio has performed through the month of November, talk about some economic numbers, and really our expectations going into the end of the year. We had a great month last month, so Cam, why don't you start us off with some economic updates here?
Thank you, Kelly. Hope everybody is well out there. Let's start with gross domestic product. On November 29th, Bureau of Economic Analysis reported that according to its second estimate, U.S. GDP in the third quarter increased by an annualized rate of 5.2%. You'll remember previously reported the initial advanced estimate by the Bureau of Economic Analysis was for third quarter GDP to increase at 4.9%. Obviously, 5.2% is a big number. That's on top of the 2.2% annualized increase in the first quarter, 2.1% annualized increase in the second quarter, which are very normal GDP type numbers. Now we have 5.2% in the third quarter. Obviously, a lot of economic activity in the third quarter, but it is being tempered by the understanding and the forward-looking economic indicators that the U.S. economy is in fact slowing.
Absolutely. Although everything's showing a little bit of a slowdown, not falling off a cliff. That was a monster quarter. 5.2 is a big number.
That is a big number. For a $27 trillion economy, that was a big number.
So some things are working, that's for sure.
And it'll go to points I'm going to make later, but talking of that slowdown, if you look, the quoted Atlanta Fed's GDP Now growth model as of December 1st has fourth quarter GDP coming in at an anemic 1.2% annualized growth rate. So first two quarters, very normal. Third quarter, a significant upside outlier. And now fourth quarter, we're definitely seeing that slowing trend.
Which is why the Fed appears to have stopped raising interest rates.
Yeah.
The market surely believes that because rates have come down from their highs at the end of October.
Absolutely. And kind of underscoring this is really an article I read this week, and it was on Yahoo Finance, and thought it was a pretty fascinating article, so I'm going to relay some summaries of that. The article was titled, "The U.S. Economy is Still the Greatest Show on Planet Earth. 5 Lessons for Investors from a Wild Year in the Markets." So the 5 takeaways, according to Yahoo Finance, number 1 is don't bet against America. And the quote I'm going to use from the article is, "The U.S. economy is still the greatest show on planet Earth," said Bank of America strategist Joseph Quinlan and Lauren Sanfilippo. The pair described the U.S. as a $27 trillion hydra-headed behemoth that is the best at many different economic activities, including agriculture, aerospace, energy, technology, and more. So this really, Kelly, goes into the theme that we've kind of talked about for the last 3-4 years, is that we've had very much a U.S.-centric bias in our investments because at the end of the day, the U.S. is still the biggest. It still dominates most sectors. It still has by far the largest amount of investment in new technologies, new industries. It's the freest economy. We have the world's best military. And so, when you're going to focus, you got to focus on U.S. and have, at least in our opinion, a very strong U.S. bias.
Well, the multi-headed hydra, I think that also leads to the explanation of what's been going on in the economy the last couple of years since the pandemic recession, where not all industries are running in sync. So some industries may be stronger than others. We have industries that have gone through recessions over the last 2 years. We've seen a couple profit recessions where profits and earnings have dropped, but some sectors have worked through it. Now new sectors come in that are feeling some weakness, and that's kind of the rolling recession theme that we've had for a while now. And with the Fed increasing interest rates to kind of slow things down to stave off inflation, which has been really the big risk and the element that we've seen for the last 2 years. We've seen inflation come down. I wouldn't say it's solved yet, or we're not down to targets. We still have a ways to go to get to the Fed's target of 2%. But it does show that there could be a path to getting inflation under control without crashing the economy, i.e. going into a major recession. Doesn't mean recession's off the table, but so far so good.
The recession in 2023 was a given.
Oh, going into the year, it was
given.
Assumed that we were going to hit a recession this year and things were going to get pretty ugly. you look at the GDP numbers, obviously they haven't gotten very...
Well, again, and you keep hearing people, we've talked about it many times over the years, but we're now back in this stage where the pundits are talking about the Goldilocks economy.
Correct.
Which is what you said with the multifaceted U.S. economy. Some sectors are performing really well. Some sectors are not performing as well. Employment's still strong, but it's coming down. I mean, the economy is not too hot, not too cold, and frankly, not too hot, not too cold is really good for the stock market.
Right, and obviously we saw that last month, where everything's coming in mediocre. That's when the market does its best.
So let's talk about the 5 themes from this Yahoo Finance article. Number 1, don't bet against America. Number 2, China needs a new consumer-focused growth model. The Chinese model has been built on government spending, on investment by foreign partners into the Chinese economy for manufacturing, and it's been driven by debt, and it is really proving unsustainable now. Chinese consumers, consumer spending in China is roughly at 40% of GDP. Where at the U.S., it's about 70% of GDP. And this is really a big problem for China. Their model is not going to take them into the next decade. They need to more empower consumers to live in a more democratic style where consumers have discretion over their cash. They can spend it as they see fit. They can pursue interests as they see fit. The Chinese model, the years where we saw 7-8% GDP growth, that seems to be behind us right now.
Well, you get to a certain size, you can only grow so fast, and China may be at that size now where they have to continue I think they continue to evolve in, this Chinese communism, whatever it is an evolving,
well, and especially with the low birth rates,
economic model, bottom line.
It's not going to make the situation any better.
Right. So they're going to continue to change over time. There's a lot of China hatred out there. I think, the reality is, as President Xi said, the world's a big place. There's room for both the U.S. and China. And, we just have to be cautious when we work with them, bottom line.
Yeah. I mean, we could work together well if they would just not steal our intellectual property.
Well, you got to know it's going to be stolen.
That is true. Right.
That's part of the game.
So don't bet against the U.S. China needs a new consumer-focused growth model. Deficits matter, and bond investors are paying attention. We have seen the outrageous U.S. deficits running more than $1 trillion deficit per year now, and it really has hurt U.S. Treasuries. Borrowing rates have come up significantly with the rise in interest rates, and bond investors are pushing back.
Well, yeah, we're finally seeing rates at historically normal levels. What we've saw through the, from 2008 until a year ago or two, 0% interest rates, super low treasury rates, that could be behind us. And the fact that we have so much government debt out there, we have to believe that, rates are kind of more in a normalized range. Now, the reality being short-term rates will come down some, but your longer-term rates are probably, plus or minus % where they're going to be for a while. There's obviously risk on both sides, but I think we're fairly normalized.
Yep. All right, theme number 4, you cannot ignore geopolitics. We obviously now have a horrific situation going on in the Middle East. We have conflict in Ukraine. There are hot spots all over the world, and we have U.S. military ships being fired on by drones. There are a lot of issues out there, and the world is a bit of a powder keg. It always seems like it has been a bit of a powder keg, but right now there seem to be a lot of little flare-ups that could really cause bigger geopolitical market, not really affect the U.S. stock market, but certainly bad news doesn't give people a lot of confidence to invest dollars. And you could see money, staying on the sidelines or a flight to quality if things do get a little tougher.
Well, I think as you get to geopolitical issues and the unrest in the world is happening, that's just an argument to, the more you focus on fundamentals, stay close to home, where those are areas that, we can control. We know what's going on locally. And if you have good sound fundamentals, ultimately those will pay off for us.
Yep. All right, the last theme of the 5 themes, stocks are no longer the only game in town. We've talked about the high interest rates since 2008. If you wanted to make a return in the stock market, financially, you basically had to be in the stock market.
Exactly.
And now we're seeing, money market funds, treasuries, corporate debt, agency debt, all of that is paying real returns nowadays, which frankly, it's nice to be back to that.
Oh, from an investor standpoint, managing money for clients, historically, most clients, if we can long-term get them returns in that 6 to 8% range, they're going to be able to fulfill their goals, not run out of money in retirement, and maintain their lifestyles. In a world of 0% interest rates, that means all your return had come from the stock market, which subjects you to the ups and downs of the stock market. Now, if we can get, or when we are getting, 4 to 6% in fixed income and being really safe about it, again, a large portion of the portfolio that's safe, getting those kind of returns. Now, what we need out of the stock market is a lot less to get our overall target return. So this is, I think, a better environment for true investors, true savers. It's not as exciting. There's not as much, big upside. But the reality is that's not necessarily what we're looking for.
Slow and steady.
We're always going to have elements in the portfolio, but the big picture, this is, I think, good for savers, and it, should encourage saving and investment as we move down the track here of the next, time frame.
Yeah, I mean, most of our clients have several decades of outlook, and slow and steady can be pretty darn sexy when you've got that kind of outlook.
Exactly.
So, all right, to wrap it up, what are the themes, or what's the news we're going to be paying attention to over the next couple of weeks? November inflation report, November jobs report. Those things will be pretty significant. Those will be pretty significant movers of the market, I would assume, if the numbers, come in much different than expectations.
Yeah, inflation, I mean, that's the wild card, because one inflation print does not make a trend. The trend seems to be pretty good. We need to continually see the confirmation month by month. Are we getting back towards that 2% number, or at least getting, staying below the 3 number, or sticking around 3 is, I think, a good measure. From a job standpoint, the trend has been softening but not falling off a cliff, so that's good. We have more people entering the job market that maybe left during COVID. So that will probably make the unemployment numbers not look as good if you have more people entering the market. But, over time and at the relative level of where unemployment is and where it could go in the short term, it's still not in crisis mode, or
Absolutely.
What I say, falling off a cliff. So, that's kind of where things are standing. Your last point on there, the equity market inflows. Stock market, we had 3 pretty ugly months in a row: August, September, October. Great rebound month in November. And, they always talk about the Santa Claus rally. There's a lot of different definitions as to what Santa Claus rally is. But, with such a strong November, and we're going to talk about that in a second, you're going to have really a catch-up trade in place now where, portfolio managers need to get invested. So at the end of the year, they can show, hey, we were in stocks. But the reality is because of all the dour assumptions going into the year, people have been pretty cautious with their, stock market exposure. And now that we're near the end of the year, we're in rally mode. You're going to have a lot of people chasing. More money is going to be allocated towards stocks. So I think that will put a floor under the market, at least in the short term. And, with such a strong November, we're probably going to see some more upside into the end of the year, which is a good thing. I mean, that'll be nice. And it takes some stress off from our side of the table, that's for sure.
But when you're a fund manager, you are measured basically at one given point of time every year. How did you do over the last 12 months? And if you are behind, you're looking at now potential outflows from your mutual fund. You're looking at a smaller bonus. You're looking at people chirping in your ear about your performance. Yeah, you're throwing money in right now, hoping to get another 1, 2, 3, or 4% return to try to get yourself up into, the conversation.
Absolutely. And I think we're going to see that this year. Typically November, December are, strong months in the market. And the reality it does, that will carry over into January. It's not like everything changes at the calendar end. But so I think we're on a nice little run here. I think it'll continue, through the end of the year into January a little bit. Obviously, once we get into January, we'll get a better feeling as to what the landscape looks like. But I like the outlook going into the end of the year, and bar a major shock to the system, we're probably we're going to turn out with some decent numbers. Speaking of which, so in November, like I said, it was a great month. Dow Jones up 8.8%. For the year, that takes the Dow to 8.5%. So, after October, the Dow was slightly negative. S&P 500, which has really been strong all year, really driven by, 7 big, large tech companies, their returns so the S&P kind of performed in line with the Dow, up 8.9% for the month. But after the month of November, now the S&P was up 19%. We picked up a few more percentage points above that since the beginning of the month. The NASDAQ up 10.8%, taking the NASDAQ to 36%. Big surprise there. NASDAQ's been on fire, and really what's been driving the NASDAQ is the same, handful of stocks that have driven the S&P 500. I'd say that's at some lofty numbers. Valuations, I would say, are questionable. I'd say there's a lot of downside risk in the NASDAQ at this point in time. The Russell 2000, which is small cap stocks, up 8.8% for the month. Year to date, though, that only takes the Russell 2000 up to 2.7. So small cap stocks have definitely been were behind the 8 ball big time after October. Those have gotten back into the black. The world index, or the international index, the EAFE, up 9.1 for the month, taking the EAFE to 9.3 for the year. On the emerging market front, up 7.9% for the year. 7.9 for the month. For the year, up only 3.2. So November pushed everybody into the black. When we look at our portfolios, growth with income portfolio, really our balanced portfolio, up 5% for November. For the year, we're up 9.2%. Big gainers in November, Lennar, the home builder, up 19.9%. Microchip Technology up 17.7%. Nucor up 15%. NVIDIA up 15%. Laggards, our real estate position, down 2.9%. EOG Resources, which is a natural gas play, down 2.5%. Exxon gave up 2%. But year to date, the big winner still, year to date, NVIDIA up 220%. Apple up 47%. Lennar up 43%. Visa up 24%. In our portfolio, we're still hanging on to CVS, tough year, down 24.7%. Raytheon down 17.2%. J&J down 9.8%. In our dividend yield portfolio, I'd say probably our most challenged portfolio this year. High quality dividend yielding stocks, not getting a lot of love. November, we finally had a great month, up 7%. Year to date, up 5.5%. So obviously we were in the red a little bit prior to going in this month. Blackstone, our big winner, and they're up 21.7%. U.S. Bancorp up 20%. Caterpillar up 11%. Laggard in November, down 7.2%. For the year, Blackstone still up 56.8%. Eaton up 47.7%. LyondellBasell up 20.7%. Year to date, big laggers. Pfizer down 36.4%. UPS down 16.9%. And even though U.S. Bank had a good month, they're still down by 11.4% since we bought them. Our appreciation with income portfolio up 9.3% for the month. Year to date, we're up 7.1%. From a year to date standpoint, Dell's a big winner and they're up 94%. Broadcom 68.6%. JP Morgan up 20%. Union Pacific up 10%. Where we're feeling some pain year to date yet, Gilead Sciences down 8.2%. Public Storage down 4.7%. Our price potential portfolio, I'd say a decent month, only up 6% for the month. Year to date, we're up 8%. Big gainers during the month. Quaker Houghton up 24%, which we just added, probably not even a month ago. Intuit up 15.5%. Fiserv up 14.8%. Laggards, Humana down 7.4%. Corteva down 5.8%. You're seeing some weakness in the health stocks there. Year to date, Intuit still up 48%. Gibraltar Industries up 46.5%. Fiserv up 29%. Really, we don't have any laggards that are still in the portfolio. So that portfolio, we tend to weed stuff out if they're not working. Our small cap stocks for the month up 8%. Yeah, about in line with the index. But year to date, we're up 5.5% versus the index only being up 2.7%. Year to date, big winners there. Consolidated Water up 146%. Powell Industries up 140%. Federal Agricultural Mortgage Corp up 51%. Once again, we had a great month, and There's a lot of turnover in the portfolio. We really don't have any losers sitting in the portfolio right now. Our long-term price potential, good month there, up 9.9%. Year-to-date, up 20.7%. So this is where we do get exposure from the Apples of the world. Year-to-date, Meta's up 172%, Intel's up 73%, Apple up 47%. So, like I said before, I think we rally into the end of the year. Things are looking good there. I don't see a whole lot going on in the interest rate standpoint. So, bonds will be fine. We'll keep on clipping our coupons in the bond market. And, it's one of those years we don't have to worry so much about the finances, but, get through the holidays and we'll see what December numbers have to hold.
Well, as always, thank you very much for your trust. On behalf of the entire Ellsworth team, we hope you and your family have a great holiday. If you need anything, please feel free to give us a call, and we'll talk to you again in 2024.
Thank you, and happy holidays.
Happy holidays.